Okay, so welcome to the last research race. We have some candidates who didn't have the opportunity to present the project, and there is Sid and Daniel. And Daniel had like the opportunity to present himself, I guess, in the call. So maybe Sid, yeah, if you, we can talk who should start, but if you talk, you can maybe present yourself, your background, and then present the project. And I guess just that you present the project, and then we may ask some questions, and then yeah, we go next. So who wants to be first?
Yeah. I can go first.
Yeah, let's do
Cool.
it.
I'll share my screen.
Yeah, thank you.
It says host disabled participant screen sharing. You need to
It's next to the green button there. There's a small animal.
Now?
Okay. Yeah, now it's working.
Okay. Yeah. Thanks.
Okay. Cool. So, hey guys, my name is Ramesh. So today I'll be presenting FEI protocol. Before I start, a bit about myself. Currently an investor at a firm called Nascent. Nascent is an early stage crypto investment firm. We do venture, we do active trading, we have a liquid portfolio of tokens. We also are building technology for automated trading in DeFi. We've been around for about a year now, and we have over 30 plus investments in the space. So quite active. If you're working on a new project in this space, definitely reach out to us. We'd be happy to chat. Before Nascent, I was an independent consultant for a few companies in the ecosystem. So I was working with DYDX, which is a perpetuals exchange in DeFi, working with Value, which is a Latin American financial institution, Matter Labs, which is a zero knowledge scaling solution, and then also worked at growth at Dharma. So I've been investing full time since 2020. Also an investor in Aladdin DAO. So I'm kind of involved in this research race. Also kind of full time in crypto since 2017. That's a bit about myself. So let's dive into what FEI is. FEI is a completely new stablecoin mechanism that's designed for scalability, liquidity, and low volatility. And it's an algorithmic stablecoin. So what does that mean? It's a stablecoin whose mechanisms are all wholly on chain, minus oracles. It has an algorithmic peg mechanism to keep the stablecoin stable. And also either has no collateral or collateral that's volatile to keep the backing of the stablecoin in place. So for peg stabilization, FEI, the stablecoin, uses a concept called protocol control value. I'll get into how that works and what does that mean in a bit, but that's what it uses for peg stabilization. And new issuance of FEI can come from minting Ether or using other ERC20s on bonding curve on the protocol. That's how you actually issue new FEI to the system. It's that you take Ether or ERC20 to a bonding curve on the protocol, and then thereby you issue actual new FEI into the system. FEI is always redeemable for $1 with a 1% fee. So there's a reserve stabilizer at 99 cents where you can go and redeem $1 worth of Ether at the peg price. FEI, the protocol itself, consists of two tokens, the stablecoin, obviously, and then Tribe, which is the governance token, which governs the protocol control value, which is currently over 900 million at the time that I wrote this presentation. Okay. So how it works in a nutshell, a purchaser comes in with like $1 of Ether and then receives one FEI coin in return. FEI is actually redeemable. This is an old GIF. The protocol itself functions like a central bank and defends the peg in the market directly. So let's say the peg is below $1. That means there's too much FEI out there. That means the protocol needs to buy up excess supply in order to bring the peg back to $1. And in the case where the peg is above $1, that means there's too much demand for the stablecoin. That means people want it and they're buying it on the market. So the protocol needs to mint more FEI and sell it in the market to push the price back down to $1. So that's kind of how it works, where the protocol functions like a central bank and it adjusts the mint and burn accordingly. The mechanics of how FEI actually works is quite involved. It currently uses Uniswap as the main pool to deploy most of the protocol control value or the liquidity that it's getting from the collateral that users are depositing. and it has a mechanism called reweighting. So the burn and mint that you saw on the image here is a process called reweighting, where the trades are actually performed on the market by the protocol itself. So what is protocol control value? It's the heart of the system and the algorithmic reserve of Fei. It serves as collateral for the minted Fei in the system. You can think of it as a subset of total value lock, except the protocol outright owns all the assets that are locked in the smart contracts. So the protocol itself controls all the assets that are being deposited to it. So design principle for this protocol control value is to own only decentralized assets as collateral. So right now it owns Ether, DeFi Pulse Index, DAI, and RAI, Reflexor RAI. Those are the current assets it owns in the platform. Actually, also owns Index, which is the governance token behind the DeFi Pulse Index. But yeah, the design principle is to only own decentralized assets as collateral. So how does this compare to something like Aave, Compound, or Maker? I like to think of it as like user control value for systems like Aave, Compound, and Maker, in the sense that users have over collateralized loans. That's like a one-to-one relationship with the protocol. Whereas in PCV, or protocol control value, in Fei, many users deposit capital to a protocol, and the protocol itself controls that liquidity and issues a stable coin as a result. So there's like a many-to-one relationship. I mentioned earlier that the protocol has bonding curves for minting new Fei in the system. So if you don't know what bonding curves are, they're price functions for a token that generally involve a token being minted in exchange for an underlying asset. And Fei's primary issuance mechanism is through bonding curves. And importantly, they're buy side only. You can't sell to the bonding curve. And the reason for that is that Fei prioritizes liquidity in the system, and by having sell side liquidity on the bonding curve, that actually causes an issue with the liquidity, and it cannot actually really improve the liquidity in the system if it has a sell side mechanism to it as well. And the price function of each bonding curve is based on the amount of Fei purchased on the specific bonding curve, and it's not based on anything else. It's just like on the amount of Fei purchased. There's certain parameters like the scale target, which if it's met, one token of Fei is actually exchanged for $1 worth of collateral. And like I mentioned before, the bonding curves that are currently supported are Ether, the DeFi Pulse Index, which is a basket of DeFi tokens, DAI, which is a stable coin, and then RAI, which is also another stable coin, a decentralized stable coin. Okay. So this is like a chart of the price history of Fei. You can see it had like a bumpy start. This is the genesis event of Fei, one of the most seminal events of DeFi this year, if you remember. It started off with like really early price fluctuations. It lost its peg and went through a certain amount of liquidity issues. But through like DAO action and community voting, the peg was restored back to $1. And since then, they have pursued many integrations with different protocols in the ecosystem, and are now like maintaining its peg directly at $1 and it's stable. And right now, the currency can be actually redeemed 3.5 times over. Even if ETH plunges like 70% in a down market, the protocol has enough collateral to backstop a liquidity crisis. So some yield opportunities for Aladdin DAO here. Right now, Fei is incentivizing a 3-curve meta pool, which is a stablecoin pool by Curve. It's not whitelisted, but you can go on the staking dashboard of app.fei.money, and you can find this pool. There's about $130 million in TVL. Disclosure that I had to give earlier, we're an investor in Fei protocol through Nascent, so this is strictly just for research purposes. Whatever I'm giving is not financial advice. Worth to make that disclosure here. This is a pool where you can deposit Fei or a single stable coin or all the stable coins, and 4 stable coins in there: USDC, USDT, DAI, and Fei. And then that combination and staking the LP token actually results in giving you about 40% APR right now, the current market rate. I'll stop here and take care for questions.
Yeah, cool. Nice. Yeah. Yeah, I put some money in at the start, but then I lost like touch to the project because, yeah, it was so bumpy, And
Yeah.
but I've got some question or more elaborate. So it's not, what do they do with the ETH? It's just sitting in the pool, or do they have some kind of treasury management? Because somehow Tribe governs the ownership of the ETH, I guess, or all the assets.
Yeah, so most of it is sitting in a Uniswap Fei ETH pool for liquidity. So it kind of functions like an algorithmic market maker, where the protocol itself deploys liquidity for the stablecoin to make sure that there's low volatility and there's enough liquidity to trade in and out of the stablecoin. And there's like part of the liquidity that's sitting on Compound. There's a bit of diversification sitting in like Rari, which is another lending protocol. So they've diversified the treasury to like have some deployments in like Cream and Kashi and SushiSwap. So they've done a bit of deployments into different protocols. But the main amount of Ether is sitting in a Uniswap pool, Uniswap V2 pool.
Okay. Yeah. In fact, they also could lend out this pool somehow and generate like a stable coin and.
Yeah, they're lending out the stable coin that they've. So there's part of the mint that actually sits in the protocol itself, and they're lending out the Fei to earn yield on a protocol called Rari.
Okay. Yeah, cool.
Deployed over $20 million to Rari.
Yeah. Nice.
Yeah.
And
sorry,
Dainel.
So my question is, I know that there's some other algorithmic stable coins, and the kind of like end game always is how to reach kind of widespread adoption with token pairs. So I wonder just like what's because I have seen like how beautifully it was after the bumpy start. It was beautiful to see that it actually got stabilized again. So I wonder what's the strategy now that it's kind of on that stable phase, if there is any kind of progress on achieving adoption on token pairs, or what's the line of strategy there?
Yeah, as far as I know, like the focus for them is to get integrated into multiple DeFi protocols. They want to be the DeFi native stablecoin, right? So in order to do that, they have to pursue integrations. So they currently have a proposal out on Compound. They're in voting for Aave, I believe, to get listed. So they want to just get added to different platforms and have liquidity, mainly on the lending markets, the popular lending markets. So there could be borrowing activity of the stablecoin. But really, like the focus for them is to become a pair for other assets as well, right? And incentivize those pools. So partnerships with different platforms like SushiSwap, Uniswap, and so on would sort of be like the roadmap for them coming ahead, going here from now.
Cool. Yeah. So I guess there's also so Fei is very like it's kind of at the taking this evolutionary step from, say, like, you know, if we had USDC and USDT and Aave, as you mentioned. And then I know that there's also the more quirky style of stable coins, or more quirky style of
a lot
of pegs like Frax and
Frax at least is collateralized fully, but others, you know, the ones who faded away, you know.
Yeah, like Ohm is like a crazy example, right?
Yeah,
which
I don't know.
They're trying to achieve similar goal in the sense that they want to become that like natively integrated in protocols. But I wonder if there's quite a strong debate to say that stability eventually will have to migrate away from pure fiat base into something that really is more protocol native. I don't know if this is like too early to talk about, or it's something that is like already of consideration.
Yeah, right now, Fei uses a price oracle which is dependent on the off-chain price oracle of ETH USD. So it's like depending on the US dollar. So there's a question philosophically whether you think the US dollar is going to go away or not. I think the US dollar is going to stay. Maybe its dominance worldwide and globally will probably reduce over time, but the US dollar is not going away anytime soon. So the reliance on price oracles probably will stay. But there are like designs like Reflexes Rye, which is like working really well and it's not pegged to anything, right? So that's like an experiment that will run, but I'm not totally sure like whether stability is like going to continue like holding to the dollar. It's just that for usability for users today, like what is easiest to understand and like use is like actually referencing the US dollar. That's why stable coins are flourishing in the market. So I think until stable coins are in existence and being used as collateral for trading and collateral for derivatives, people are going to like trust using the US dollar. So that's not going to go away anytime soon.
Yeah, I did think a lot of algorithmic stablecoins 1 year ago. They play with ample force, who has a design who will never work. But somehow also, also at the beginning, like DAI, they had like the idea to make like, not to make a dollar peg stablecoin, they had the idea to make like to take like Banco, not Banco. Yeah, there's this basket currency, Banco is it called, who never found traction. And there are many different currencies in one currency somehow. And the other thing is, if you think about pegging, you need something to peg, and then you need like a consummation, a basket of people, which is stable, which keeps your currency stable for daily purchases or something like this. And I think this is not possible in the world we live right now, because every different economic structure has different price structure, and so I think it's really hard to make such a basket who is worldwide, who can be worldwide, be a reference, because now it's
like
a US dollar,
Where's the demand going to come from for it?
Yeah,
right? Yeah,
this is true. This also, but I think it's important to have stable coins who are like really decentralized. And one issue with Maker, we all know, it's that mostly it's USDC in the background, and this somehow is strange because Circle can just stop DAI somehow, and then I don't know what's going to happen then.
Yeah,
so they
I think
can just kill it.
Fei is like prioritizing decentralized
Yeah.
collateral assets, right? They're not taking in USDC.
Yeah.
So governance is very strong on making sure decentralized assets are the ones used as collateral. Yeah.
Cool.
Okay.
Yeah.
Thank you very much. So I guess we go over to Daniel's presentation now. You present you both.
So. Cheers. Yeah, thanks a lot, Sid. I think it was good to kind of do catch up on Fei, because I haven't been very like up to date. So thanks for this. I figured, so when we discussed, when you first invited to share, Martin, I thought about several different DeFi projects to share, and decided to go with something that is in the crypto land considered as very conservative, and also a company we invested in through Collider when I was working in Collider. So Stakewise, Kirill is actually one of the co-founders. It's very interesting how I think that while we're while Sid discussed the stability of USD becoming like kind of retaining dominance over at least the foreseeable future now, right? I think that for the world I see, we're seeing so much denomination in ETH is becoming very prevalent. I think with NFTs, it's probably like something that cemented it even further. And then that's where, when we're looking at what Stakewise is doing today with shortly, Kirill will share, we're basically looking at yield farming or DeFi opportunities which are purely denominating in ETH. And by that, they are the equivalent of what you would otherwise look at denomination, the stablecoin yield farming, that it's like relatively low risk strategies with also lower yield. You don't see like 1,000,000% and some kind of ape activities much. But then when you're looking at a world denominating in ETH, then you're starting to think, okay, how do I optimize my yields denominating in ETH? And this is where I guess like Stakewise made a lot of sense as a conservative approach to yield. And I guess specifically the liquid staking part, but maybe more broadly speaking about Stakewise, Kirill will share the kind of background as well.
Absolutely. Yeah. Thank you very much for the intro, Daniel. And thank you, Martin, for giving me the floor. Sid, thank you very much for the presentation. And Faye, like Daniel here, it was great to catch up on what's the latest with the protocol. So I can talk a little bit about myself. I am a co-founder at Stakewise. We are a liquid ETH2 staking platform. Many people know about Lido, many people know about Rocket Pool, but not many people, unfortunately, know about Stakewise. We are slowly changing this. However, yeah, we currently are in a position where we are sort of playing catch up. This being said, we are the second largest, we have the second largest liquidity pool for staked Ether assets in DeFi. So I guess we are considered a major player in liquid ETH2 staking. We have been around ever since March. We currently have 38,000 Ether deposited on our protocol, either via solo deposits where users run validators just like that are entirely owned by them, or they run them for the pool where the withdrawal key is sort of not kept by us, but instead we use a withdrawal contract, a smart contract, to handle, to eliminate the custody over the funds. And yes, to date we have around 3,000 users and are continuing to grow pretty fast. Let me share my screen to give you a more in-depth overview. I'll probably start here. So we do work as a liquid ETH2 staking platform that you would imagine yourself. You have a sort of several layers of various entities that can participate in liquid staking, and we can cater to all of them. If you think of the flow of Ether from DeFi, be it users, just ordinary users, be it non-custodial wallets, be it DAOs, or on the side of like TradFi exchanges or custodians, all of them can stake their Ether with Stakewise and receive a staked ETH token in return. This token will represent their stake in the beacon chain and will grow over time to represent the growth of the stake. The Ether that is deposited into Stakewise is handled via smart contracts and oracles to be allocated to like node operators. One of these node operators is us. And then we're currently in the process of adding new node operators into the protocol. So we look to be the ultimate DAO in a sense where we have several layers of participants in the protocol, be it node operators, be it oracles, all decentralized, be it simple users, the traditional DAO participants, or those that integrate staking services into their applications and dApps, like wallets, DAOs, exchanges, and custodians. What is unique about Stakewise is the dual token system. This is something that we pride ourselves on, but pride doesn't really matter unless your product works, and we see that our product works really well in terms of the yield that we are able to churn out because of the approach to tokenization that we have. The way dual token system works is that the deposit that you make into the beacon chain is represented with one token, which we call SEF2. It's a deposit token. And then as long as you hold it, it effectively represents your stake in the beacon chain. You accrue reward tokens in a separate token, which we call RF2, reward ETH2. Both of them are mapped into Ether in the validators. So both token balances are always one-to-one with what happens in the beacon chain. And the idea here is that by separating the two, you can first of all offer a better user experience for people applying their staked Ether in DeFi. This is related to the fact that you can dispose of rewards separately without needing to sell your principal, and also because of the sort of shortcomings of single token systems of other protocols. And it's also allowing us to offer compounding to users, where they can convert their rewards into more deposits, thereby reinvesting their earnings back into staking and boosting their yield. On the graph, you see that the representation of the dual token system. If you start with 10 Ether that you deposited into Stakewise, you receive 10 deposit tokens back. And as this Ether that you deposited into the beacon chain grows to say 10.5, your deposit token balance remains the same, but the accrual of rewards happens within the growing balance of the reward token. I can briefly demonstrate the user flow to you. I think you should see it. So whenever a user looks at our dashboard, they can see the amount that they have staking, the rewards that they earned, the staking APR, and the statistics about our pool with the staking fee are clearly presented. The interface to deposit is super simple. You enter whatever amount you would like to deposit, you confirm the transaction, and you receive SIF2 tokens once you've done that. There's also a compounding option where you convert rewards into deposits. This is enabled by our liquidity pool between rewards and deposits. There's also a handy way to track your rewards. You can see that here over time, my balance has been decreasing as I've been moving more of my deposit staked Ether into farms. But this is handy for essentially any reporting purposes that you may have. With the solo product, it is pretty simple. You also do a deposit, provide your own withdrawal key at this stage, and then deposit and confirm, paying just a monthly fee per every validator that you create. Just trying to switch back to the presentation. So as of today, we have over $120 million locked. So that would be around 38,000 Ether. We also have over 3,000 users in pool and solo. The uptake has been good, and we are continuing to ramp up sort of the figures as we are decentralizing the protocol in sort of every way possible. We also have, as I mentioned, the second largest liquidity pool for staked Ether assets in DeFi. This is our Uniswap V3 pool. The reason we went with V3 as opposed to Curve, for example, is because we saw we could offer much less slippage on the same amount of capital provided to the pool. So, for example, we over the summer we have witnessed flows equaling like 10 to 15% of the whole staking pool out of the protocol, and this caused slippage in around 20 basis points, which is nothing really compared to the amount of funds moved. Similar flows have resulted in considerable slippage for our competitor protocols, and we feel verified with the Uniswap V3. Yeah, so thanks to the dual token system and the farming yield, which I'm going to come back to a little later, we are able to offer the highest staking yield on the market right now. So this is enabled both by our dual token system that enables compounding and also avoids the flaws of single token systems that I'll be happy to chat about later on. But it also relates to the fact that we have our own activation queue, and hence we don't have socialization of rewards enabled all the time. This means that as new deposits come into our protocol, we don't share the rewards of those who have been staking with us before with the newcomers immediately, only when their Ether has been activated. And this allowed us to consistently offer, a higher APR over our competitors. With regards to the farming yield, I'd be happy to share that we have 2 farms available, and they are both between Ether assets. So one of them is between deposit Ether, just Ether and staked Ether, which is the deposit part. Another is the liquidity pool between reward staked Ether and deposit staked Ether. You can see that the APRs here are into double digits. However, I should tell you that the way our farming program on Uniswap E3 works is that the tighter you center your liquidity around the current price, the more farming rewards you receive. And what this means is whenever you see this figure, this is for the whole pool, and your APR can actually be higher or lower depending on how tightly you centered your liquidity. So for example, the harvest vault that we currently have for the Ether staked Ether token is centered in the tightest range. And after the fees that harvest charges, which are quite hefty, I have to tell you, you are still able to churn out a much more more significant APR compared to just the pool as a whole. And yeah, these are the yield opportunities that we have with our protocol currently. You wouldn't sustain any sort of impermanent loss because both of the assets are Ether denominated and interlinked. So with this being said, we see this as the highest yielding opportunity for Ether in DeFi right now. You are getting Swise rewards, which is our governance token, staking rewards, which is self-explanatory, trading fees in both Ether and staked Ether, and also iFarm rewards when it comes to the harvest pool. I'll probably stop here to take any questions. Also haven't been keeping track of the time. Perhaps we won't have time for V2, but yeah.
Yeah, I think that's good. Thank you. Yeah, it's interesting. Yeah, but the first pool you just showed, this is stable. It should be around 1-to-1 because you make this dual token system.
That's correct. Okay. It is.
And is it stable? Does it fluctuate sometimes, or is it?
So, like many other assets in DeFi, it does fluctuate.
Yeah, of course.
What we see right now, what we see when we started at the moment when I think there were several hacks happening on the day, and initially we had the DPEG by 5%. So it was 95 cents on the dollar that the staked Ether was trading. However, people recognized that this is a buying opportunity. And over time, it got restored to over 99%. So essentially, the current discount is, I believe, 70 basis points, which is actually the best offer that you can get for staked Ether assets in DeFi. So yeah, if you're looking for discounted Ether that's also yielding you interest, then we're your guys. But if you want to provide liquidity in that pool, what is best to do is buy this discounted Ether and mix it up with just normal Ether and offer liquidity in that pool with no impermanent loss.
Yeah, cool. Yeah, I didn't know that staked right exists. Yes, go ahead, Sid. Yeah, sorry.
Oh, thank you. Yeah. Would you say the major difference between you guys and Lido and Rocket Pool is the dual token mechanism? What's the key difference you think?
Yeah, so I think it's a great question that we get asked a lot. The dual token system is definitely the main differentiator right now. So it allows us to churn out a better yield for staking. What we also are seeing is that the decentralization architecture that we will be coming up in the following weeks is an improvement on the existing protocols. Exactly in which ways we'll need to share in the a separate blog post and the announcement, but we do expect it to become the new standard. So with this in mind, you know, I wouldn't, I don't want to be just don't want to say anything that doesn't have evidence. Right now, I say that our main difference is the dual token system, and when it comes to decentralization, let us release it and you'll see.
Yeah, I see the other one difference is also that in Lido, if there's a lot of demand going into staking, then you share your revenues with all the other, or you have to wait in the queue, and then the revenue is shared with the ones waiting somehow. And I just did see some month ago that people think that there will be a rush. Sometimes they will rush into staking. The queue will maybe very long, and then with Lido you have to share it with like everyone. And in your solution, not, as you said, or is it only, is it is in the pooled system? Is it also true?
Yes, yes,
Okay.
exactly. This is our way to protect the existing stakers in the protocol from diluting their APY. Because otherwise, like you said, when the merge happens, we expect an influx of deposits into ETH2. And what this means is for like a really long time, everyone in the protocol can be suffering from dilution of APY because of constant growth in deposits. If we ask the people who are coming in to wait out in their queue, we actually see that over time they will earn better because they do wait for a little bit of time, but after that their APY is full the way it is intended to be, and they can sort of rest assured that everybody else that's following them will not be diluting the APY, but instead be going in the queue as well.
And one big topic, but it's a little bit also like off topic somehow. One thing is just about the centralization of staking, and this is for me. I'm not staking currently, but somehow it's concerning, I guess. And we see that there's like decentralized solution like you and Lido somehow too, but also like the big exchanges, they do stake for their clients, and there you can have one click and it's very easy, and nobody knows who this is playing out, but somehow it's concerning. Yeah, I don't know.
It is.
Can I say a few words?
So if we look at the distribution of deposits in staking, we see that around a third is just delegated deposits, and this is what goes to all of the exchanges, liquid staking pools, and say institutional offerings. So there is still a huge percentage of nodes that are being run independently, which is some sort of a solace. But at the same time, we do expect that going forward, it is likely that there will be a concern of centralization growing in the space as liquid staking protocols sort of take a larger share because of growing adoption of staked Ether tokens in DeFi. With this being said, there are solutions like secret shared validators that at least 2 teams are working on that are intended to sort of alleviate the concerns about centralization. The idea here is that anybody with a validator key can take this validator key to like one of the protocols. One of them is secret shared validators. It's called SSV. Another one is also working on the same technology, but it's called Boule. So they can take their validator key to these protocols and choose whom they want to run their validator with from, say, hundreds of different providers. And what makes it possible, what's the catch here, is that you will be able to run the same validator on several machines in parallel because of this protocol is essentially introducing a multi-sig for your validator. So, for example, you want your validator to be run on 6 different machines. You give your key to 6 different node operators, and you set a threshold. So, for example, if 3 out of 6 vote, it means that the validator has performed its duty. So what it means is free can fail and your validator can still work. And at the same time, it means that more node operators can be running nodes as some sort of a redundancy strategy. With this in mind, you can imagine, say, all of the validators in the network being run by, say, hundreds or hopefully thousands of node operators, and at the same time not have like a direct responsibility for these validators, because there are other backstops in the face of other node operators that they're sharing the validator with.
Okay. Yeah, I don't know. Sid, do you have further questions? Or?
No, I don't. This is really informative. Thank you. Appreciate the presentation.
I would have many questions, but I think
Yeah.
it's too long otherwise. Yeah, I think I don't know, Dainel, do you have anything to add to this? So one question is that maybe both of you, Sid and Dainel, Sid, you said you invested into Phi, and Dainel, you said you invested into Stakewise, and for me, it's also as a non-investor, like I only hold tokens, For me, it's also it's every time the question, do you hold like equity or in the companies, or do you hold token, or do you have? You don't have to answer this. Maybe it's too private, but from outside sometimes you don't get it. Yeah, if you're an investor, have you bought token for a good price, or do you hold equity in this company, and how does this work? The token, and how does it play out with the governments? And yeah, maybe it's. You can also ask this in general way.
Yeah, you go, Sid.
Yeah, I'll go. Yeah, I mean, we hold equity, which is with the token warrant. So that's an issuance of the token for equity holders. It's pretty standard, like how it's done, like for many raises, like you hold equity in a business, and then there's a token warrant that's like issued pro rata to holders with the equity. So that's kind of what we have at Fay. We led their pre-seed, and we were the first investors to write a check.
Okay.
Yeah.
So you have like a vested equity.
Yeah,
somehow,
vested tokens.
Yeah.
Equity is in the business, but we have vested tokens. Yeah.
Okay.
Yeah, for investors, it's over 4 years for a tribe. So we're vesting that right now.
Cool. Yeah. Thanks.
Yeah, and I guess it varies between deals, but SAFTs, you can also do tokens directly without the equity part. So you basically are buying tokens pre-liquidity, and then they'll be vested depending on the conditions once they're getting to market. I think you see it more with DAOs these days.
Yes.
Sometimes there's even DAO deals that you don't even have a SAFT. You just have treasury diversification proposal, no KYC. But yeah, like from what I see, there's much more direct token deals than equity in this super cycle. Like everyone's more warm to it.
To add, I've been working for the DXDAO, and we also had like quite a huge treasury. So we made like 1 million has been allocated to make investments, but the DXDAO, doesn't have like an entity, So it's only possible to make like token deals because the DXDAO couldn't hold like equity because nobody can sign for this company or entity somehow. And the Gnos Aldin DAO also has no entity, but that's not the goal to make investments. But we see that somehow the DXDAO could only make like token deals somehow. They invest like into Opolis, I guess, and there's an upcoming right now. But I have left DXDAO, so I'm a little bit out.
Yeah, actually, so I left Collider where we invested in Stakewise, and since then I'm working on my own fund and I'm farming Stakewise actually.
Yeah.
So basically, like our less risky strategy of ETH yield, because we're denominating a lot in ETH, is basically earning us twice. I think it's quite attractive. Like it's super underpriced as we see it at the moment.
Yeah.
So, you know, like
Yeah.
as we see it, the 15% APY, which is mostly with Twice, is like has the potential to, if you're looking at the re-rating of what we believe it goes to, similar to how, you know, in the early days, people are looking at Sushi or Curve or those things that are very low initially, but then becomes huge. So that's the rationale.
Yeah, we will see how Aladdin DAO is going to, you know, at the end, I guess like 4 projects a month should be voted for by the members of the Boule, and then I don't know if there is like how the process is working. We will see, you know, how this. At the end, I guess the candidates members themselves can like propose stuff, and then we will see who.
What I'd be really interested to see if we'll do in Aladdin DAO is you often see in funds, more so in liquid funds, you would see that there is ranges for risk categories where you would have, say, like up to 20% high risk and say like 40% that is lower risk. I would be really keen to see if we can come to some kind of like a risk adjustment portfolio composition.
I don't think that's. I think how the code is right now, this is not possible, I guess.
Right.
Yeah, right now you just whitelist certain pools for
But
farming.
of course, you could label it somehow for the end customers. You can say this is like somehow, you know, you can just name it like this without having like coded
you can
it
do
itself.
it in the UI. You can do it in the UI.
Yeah. Somehow you can say this is more, I don't know, more conservative investment with long-term outlook, and this is maybe more short-term. Yeah, we will see how this plays out.
You guys invested in Aladdin through Nascent?
Yeah, we did. Yeah.
Cool.
Invested in Aladdin. Yeah.
Yeah. Cool. I think that's it. Yeah, the outlook is, you know, as I try to get the governments running for the Aladdin DAO, and somehow it's like, we are trying to find out the process. And but I guess, you know, the Boule, if the vote is over, could be one source of governments. Somehow this is not written down, but I think we need like a government structure who is able to move faster, to make decisions fast, and you can't ask all the time all the whole Aladdin holders. And I think this is this stuff to discuss. But I would try is to do, it's just an outlook to make like a weekly call. And this, I think it's my next initiative, that we find like a date where we can just have a weekly call and discuss about this kind of stuff. And another thing is what we have to address. Maybe it's not addressable, but I see there's like the team is somehow, or people working now right now on the Aladdin side. Some of them are Chinese speaking, and I guess one is only Chinese speaking. And I think one of the tasks to bring is this community together, and we will see how we will evolve. Yeah, so happy
we need to find the right meme lords.
Yeah, these two, but we need to find people who want to build the government, you know, because I think it's just, the territory is so, there are many different ways to do it. And there are also tools now, you know, evolving, and we will see which tools we can use. I guess what I did see with DXDAO, there we built like, we use like DAO Stack, who is like now defunct, and this is like a huge risk, you know, you use the tool and then use it for certain times, and then the company doesn't support the tool anymore, and then you have to replace it, or you have to build it yourself. And then maybe it's better to use like pre-existing tools and not build stuff yourself, but then you have to risk that if the tools are not used by many others, then it gets old and you have to replace it. And many challenges.
Yeah, especially that most DAOs today are using Snapshot and Gnosis.
Yeah. I'm not used to this, but of course it's the natural way, you know, somehow. But somehow it's also like a good weather system, because then you need to trust the multi-signature holders to really do what the government is telling them, you know. And if they don't want to agree, then you have like a big crisis in the DAO.
Yeah, it's so like you've been using Alchemy with DXDAO, like so
Yeah,
know. I've also been using DAO Stack Alchemy since 2018 or 19, and I remember when DAO space was so small, so there was a lot of room. Also, it was crypto winter, so there was a lot of room for like discussing what does it mean like to really have governance, decentralized governance and stuff. But eventually, I think when DeFi happened, like when DeFi summer started happening, what we realized is that, like, okay, let's be frank here. And I know you're still recording, but okay.
I can turn it
like,
off. I can turn it off.
Like,
we can stop it here.
It's like,
Okay,
I think it's no secret anymore. No secret anymore. But like much of what's happening in DeFi with the like DeFi DAOs, so to speak, it's the main benefit of using DAOs is removing or at least reducing to a far enough degree regulatory risks.
Yeah.
And then people don't mind so much how truly decentralized it is. Much of it is a charade. It's kind of a decentralization theater. But
Exactly.
I think that nevertheless, like, you know, like no need to be too cynical about it. Nevertheless, that like step back from very radical, you know, collective intelligence inspired DAOs that we were looking at in 2018-19, that step back to just the basics, you know, the primitives of governance, which is a multi-sig and signaling, snapshot and gnosis, right? That's kind of like training people to start getting accustomed to those processes. And then I think that the emerging tools that will come out of it would be more organic than the beautifully engineered alchemy, which I love. I think holographic consensus is a beautiful thing, but I think it's just like, it's a bit, ironically, it's a bit top down. It's not something that is very emergent. It's something that is much more like a, like I ran the first hackathon using a DAO with Alchemy in 2019. And man, like people hated me for that. Because basically like I onboarded people to do like holographic consensus protocol, and they need to also win a hackathon.
I never completely understand the protocol, you know, it's just.
I
think that's very interesting. I think what's going to happen is there will be some crisis because, as I said, you know, the breaking point is there where the governments, the token holders decide something, and the team who is on the multi-sig refuses to do it. You know, then you have. I think we will see such events, or we did already see such events. You know, one is that they had like a decision to burn the keys. They didn't burn the key, and then half a year later they came up to make more tokens. You know, this is maybe not a big crisis, but it has had a lot of discussions around this. And I guess we will see more of these kind of breaking points, and then the need to have tools who really enforce like decisions of the token holders will grow. And maybe you're right.
The point it will really happen. Sorry.
There's contentious upgrades too. Like for Uniswap, they wanted to go to optimism, but the community voted to go to Arbitrum.
Yes. Yeah.
So like governance plays its way into like different ways to where the central team might not want something, but the community wants something else, right? So there's a convention.
Yeah.
There's also this
like
reputation risk.
Some of the catalysts to kind of go further with how decentralized things are going to be the regulators, because the moment people can be pinned down, I guess maybe the Uniswap lab. Okay, bye Kirill. Yes, we're just like starting to
I stopped.
Not really critical, I guess.
Yeah, thank you for giving this presentation. Yeah, interesting project.
Thank you very much.
Thank you.
If there's anything I can tell you more about Stakewise, let me know. I'd be happy to jump on another call or just talk async. Thank you.
Cheers. Ciao. I stopped recording.